All right, we are live on YouTube and TikTok. We're gonna start in a few moments. We're just waiting for a few people to come in on our lives. I did post it recently within our Discord, which is the community that we host that you can join absolutely for free. We'll talk about stocks, commodities, Forex. Our primary focus is cryptocurrencies, and we do offer a premium service for education in terms of videos as well as books that we do provide, and also the trades that we are taking. But we will get this recording started now. I think we have enough people. All right. Give me one moment here while it's getting started. Just gonna make sure the screen is sized the correct way. I was filming something else. All right. Hey traders, welcome to a global macro update. We'll be going over mainly the SPX or the S&P 500, the 500 largest companies in the United States. We'll be going over DXY, which is the US dollar currency index, and then we'll be also going over the historic charts on the Dow Jones back in 1930s at the start of the Great Depression. What happened, how the current price action looks very similar to the 1930s in how the structure is laid out, and then we'll also talk about how we're looking at the markets, why we are looking at potential shorts, and we've already have shorts in place we're looking to add for specific reasons, and we'll get all into that within this video. First things first, just looking at different asset classes. We first have BTC or Bitcoin at the top, S&P, and the Russell 2000, if you don't know, is for the small caps. S&P, like I said, is the 500 largest companies in the United States, and I'm sure you hopefully know what Bitcoin is. Now, looking from the high to the low and then drawing a Fibonacci, seeing our key levels, the 61850 and the 382, we see that Bitcoin is showing a key level of resistance at the 50% retracement. S&P is moving in between the 50 and the 618. It was kind of in between there from the daily candle closure high to low, and the Russell 2000 has not even broken the 382, so it hasn't gone above 38.2% of the high that we've recently hit. So small caps, obviously, with more speculation. There's definitely fear in the marketplace, so there's less speculation on small caps. And it seems like S&P is obviously getting more of the stimulus in this current situation that we're having here. So let's now go to the S&P 500. This is the 4 hour. Let's actually look at the 1 hour first. Or sorry, the daily chart. Let's first discuss what we currently see, and then we'll jump into the 4 hour time frame, because that's the key time frame I'm looking at, because I am a swing trader, but we are looking for a potential very long hold here because I am very bearish on the economy. It's unfortunate to say, but it's the reality of the situation. And as a trader, we are looking for opportunities. The fundamentals could not be more bearish. 25 million people are currently unemployed, filing for unemployment, and it's continuing. It's not really seeing too much of a slowdown, which is sad to say. And then obviously oil is a complete other monumental historic event all on its own, not even tied, well, it's tied to COVID, but it's a monumental event on its own. And then COVID, with the lack of demand for the product, is just putting them in a hole that obviously is very hard to get out of. So looking at the chart here, we're looking at two May zones, 618 and the 50%. Like I said, we reached a high of around the middle of the 618 and 50%, and we've broken our ascending support connecting the higher lows. We are pulling back, and when we do look at the smaller time frames, I can see a nice little ascending zone break created a descending triangle pattern. So then I do have also an example of something similar that happened on BTC, which we'll get into later. But in terms of the price action, it's following market structure pretty well. We are now holding a key level of horizontal demand, and then when you look at key structure changes from an uptrend to a consolidation to a downtrend, you're looking for a series of higher lows to stop, and then you're getting a consolidation, not being able to really make a higher high. So what we're looking for is ideally a descending trend line connecting the lower highs, or at least a horizontal zone that is able to hold the price in a consolidation. And now we'll get into the 4-hour chart to discuss the current price action. So this is the 4-hour chart, like I said before. Let's take a picture of it yet again, and then we'll discuss what we currently see in basically this middle of March until now. We've seen a huge pullback, hit in between the 50% and 618, and then we see that the price made a high, higher high, higher high, but then on the smaller time frames, we started making these lower highs here. We drew a trend line. There was a tiny little descending triangle there on the, let's say, 15, 5-minute that did break down, retested, pushed to the downside, and now we are holding just above this support here at around 2,700. That's going to be our key break, and that's what we're going to be looking for a potential move to the bears, where we're going to have a solid shift where sellers are really going to take charge. So basically, that is the current structure that we see. If we do see a push to the upside, that's definitely going to give me a lot of hesitation in terms of adding more to a position because of the series of lows getting broken. But at the end of the day, I am expecting this supply zone to hold. If it does break the 618, my bias has to change. Unless there's a wick and then it comes right back down, then I could still have a bias of a bearish sentiment. But if it does continue to push to the upside, basically the Fed is destroying the dollar to save the stock market and not really the economy. You can't really save it at this point if, you know, millions and millions of people are out of what they want to do in getting basically UBI. That's not really a fulfilling position to be in. If you love your restaurant and it's closed or something along the lines of that, it's very difficult. But that's kind of the current situation that we're seeing. If it doesn't actually break to the downside, then I would be basically looking at gold and BTC cryptocurrency markets to soak up the kind of investor speculation that is a safe haven, where gold has definitely stood the test of time. BTC obviously is getting tested now. I don't think the test is over. It takes a lot longer than a couple months. This is like very recent, right? Like this is when we really started. End of February really is, middle of February is when we really started to see the market drop. So it's very early into this bear market. I still think that BTC is going to outperform gold in terms of price appreciation for investors using it as a safe haven and a store of value. We live in a digital age. There are definitely benefits of having a digital store of value compared to a physical. I know you can tokenize gold, but that's basically still using blockchain. And that said, that is the completion of the S&P. Now we're going to go and look at BTC and the breakdown that we saw during, I believe it was end of January. We'll look at it right now. I guess a similar time. End of January was the starting, and then we saw the breakdown in February and especially March. So let's just take a picture of this. And then hopefully you see the similarities where we do have an ascending channel within BTC, whereas the current price action of the S&P is more of a wedge, where you have a less ascending resistance and a more ascending support, creating a squeeze in the price, whereas this current structure that we saw in BTC is a series of higher highs and higher lows that is not really creating a squeeze. It is just an ascending channel, and then you're looking for a break in the key level of support, which is connecting the higher lows. And we can see that right here. We initially got a break down below the support zone. We did get a pretty aggressive retest that we saw, but it was in confluence with our high, our lower high, and our lower high, creating our zone of confluence there. And then that created our triangle And once that broke down, we saw a nice squeeze, which was, you could call it an ascending trend line, an ascending wedge. Let's just draw that a little bit better. Let's get our tool and we could draw it like that, something along the lines of that. And then we saw a huge breakdown. And I'm not saying that we're going to get this aggressive of a move. Obviously, with circuit breakers and regulators basically controlling normal free markets with stimulus and with circuit breakers and all their other shenanigans that they pull, that's obviously not free markets, and I don't really advocate for that. I would personally rather see central banks not play a role and have a protocol or a program like BTC provide the monetary system, so then it's predictable. I'm not going to have anyone overreact like they're doing right now. Every action has a reaction, and the amount of money that they're printing will have a reaction. It has to. It's not like $6 trillion of money printing will not have any sort of reaction within the economy. All it takes now is just the velocity start back up, because it's plummeted off a cliff with lockdown, obviously. So I hope you understand the similarities that we have with the BTC chart back in February in the breakdown, where you saw the descending triangle breakdown. You saw this continuation pattern, and now we're going to look back at the 1930s to see a very similar structure. So we're going to close this. We're going to go back to this page. We're going to go to DJI. This is 1930s Great Depression. This is the first initial smackdown here from August 30th, 1929. And then the low was November, let's say, 14th, 1929. And then the consolidation upwards was from November all the way until April. They take a long time, right? But then in this situation, I just think that this fell faster because they didn't have as many circuit breakers. I don't exactly know if they did, to be completely honest with you. I didn't do my due diligence on that one. But, with the amount of, I guess, interference that the government is using, does not surprise me. But in terms of the actual market structure in the price action, we see that it's actually very similar. Let's go back to what we currently see in the market. We see a nice ascending wedge with the price connecting with a series of higher lows. First rejection, second rejection right here, very well respected. Third rejection, we may see the pullback even come up to form a double top. I'm very all right with that. I'm all right with pushing this a little bit higher. I still have a bearish sentiment, and I view the 618 and the 50% zone in between this area as a key level of supply. Looking at this further, we saw a dump to the downside, which didn't take very long. We saw consolidation. You could view it as a double top with just horizontal zone or a flag, but then let's play this and see what happens. You see a very aggressive move because there's a loss of confidence in this series of lower highs and lower lows. Definitely, once it breaks that support, especially if the gap down with the news, people are thinking, oh my God, the news is catching up to the stock market. Maybe the Fed can't save us. They can't buy everything. There's no more stock buybacks, and 30 million people have lost their jobs. And it's a global event. It's not like there's one country who is completely fine. It's an entire global pandemic. So, who's going to really be buying if the confidence starts to drop, which is sad to say for everyone, which are long-term investors, but you got to look at it in terms of like multi-decade investments if you are a long-term investor. If then, you might want to think about having some sort of risk management or hedge. That's just not investment advice. That's just what I think. If obviously I'm currently a lot more bearish than bullish, but looking back at the price action, we see that there's a strong move to the downside. Let's continue to see what happens. We got a huge push up. You could draw a nice little trend line here. And then what you're looking for is previous levels of either support or resistance. And when you're actually looking at it, this is the daily, you see a nice consolidation here. We see three rejections of a resistance, first, second, and third. And then you get a dump to the downside, breaking the support. You get a test of the low yet again. Let's continue. You get a very solid bounce of that low. Some last hope here of that recent low of, I guess, 210 back in the day. Let's continue the price action. We get a poke out above the high. So that was the previous high. And we actually closed above it. That would really attract a lot of bulls in my personal view for potential buys because they think it broke the recent low or the recent high. We've tested the low multiple times and held. You know, it's attractive for a bullish potential opportunity, but we inevitably did push to the downside. And once that second low came in that rejected off that previous one, you know, it's looking pretty similar to this. You could connect a horizontal trend line or support zone like so. If that breaks with the recent low there, you kind of know that all confidence is kind of going to go out the window if it does break that recent low. So let's continue to see what happens when it breaks. You just get, well, actually not terrible, but it wasn't as bad as the initial blow. But you definitely get a severe move here. Let's just see, you got to push to the downside, a pull back, and then you're looking for the meat of the move, 18% low, 20%. That's a significant move. And if you're looking for entries around this key level of supply that we're currently at, you could catch some unbelievable opportunities in my personal view in terms of risk reward. Let's just continue on. You know, it just continues downwards for a very long time here, but looking at how this structure played out and how this structure currently looks in the market, I think that they are pretty similar in terms of the price action. You see a massive move to the downside. You see a pullback to a key level of supply. You're looking for weakness. You do see, if you're actually looking on the smaller time frames, a lower low that came into the market. So theoretically, you could draw a potential trend line connecting the lower lows, and you have a descending channel. Yes, that could be a bullish opportunity, but in terms of the fundamentals, in terms of the overall structure of not just the 4-hour, but the daily chart, the weekly chart, basically every time frame, if you're looking at it, in my view, because I have a bearish bias, could identify it being a potential sell. So that's my view of the current market. We do notify our premium members when we do enter. And we do have exposure to the short side using contracts for differences, or CFDs. They are somewhat similar to futures in that you trade a contract that is trading the underlying asset. So you're not actually holding it. For example, on Binance, you're actually purchasing Link or XRP or BTC, whereas on these derivative exchanges or using these contracts for differences, you are trading a contract. You're not actually trading the actual asset, and you don't get any delivery, whereas futures, you do get delivery. And we did see some people get roasted pretty bad by buying oil futures, and then what do they do with the delivery, right? Difficult situation. But yeah, that is my opinion of the S&P. Hopefully you got some entertainment from it. This is not financial advice. Always do your due diligence. Get multiple different sources and really think about it for yourself. And we wish you the best. It's obviously a very volatile time. And manage risk well if you are using heavy amounts of capital to trade. If you are like a perma long investor, if you don't plan on holding for like 20 years, just think about the wait time that you'll have to have basically in order to get back to break even. But we really hope you enjoyed the video. We will answer comments at the completion of this recording. So if you have any comments on YouTube, if you are watching this recording, drop them in the comment section below. And until next time, have a good one. Alright, so that's the completion of the recording. I'll go over any questions now. Let me just get this saved, and then we'll go over anything that people have missed or people have questions about, like TA, or let's look back at different historic time frames. Go look at DJI on TradingView. You can see it goes back all the way for 1930s. 1928 and then on, you don't have really anything for trading, but you have open and close, or just open, I don't exactly know. But you have just one price per day that shows you kind of where the price has gone, which in my opinion, if you are looking at the historic recessions and all the things that's happened within basically the entire historic economy since 1929, you can see how Dow Jones reacted, which in my opinion is extremely cool because price action says a lot. And if you're a technical analyst, it's absolutely fascinating. In my personal view, everyone has a different view of it. But anyways, okay, let's go to the questions. Do you day trade by gem? No, I do sometimes now. Usually I did before, but at this point in time, because it's volatile, I'm just looking for the big, massive move that's coming. Looking more at fundamentals aligned with a long swing trade, basically. I do intend on holding this for a while. But yeah, basically there's a lot of noise. There's a lot of volatility, emotion, and during times of mass fear and uncertainty, I tend to lower my time frame. So instead of trading, let's say 5-minute 15, I might trade 4-hour daily, and then use my 1 hour for the execution, just to kind of shut out the noise, give the price more room than I sometimes intend to. Just like a little more than I normally would, just so I'm giving that price the ability to move and lower my risk reward a little bit, but I do have longer extensions because I do think that there's going to be a lot of over exaggeration in terms of the moves to the downside and upside. Like, this was a massive move. A lot of people thought, oh my god, we're in a bull run because we're above 20%, but we're basically at the exact same place that we've been for every other recession after the first major impulsive move. I'm not joking. Let's look at the SPX. Let's look at 2008. So I use Fibonacci's quite a bit in terms of the recession impulse pushes that we get here. So let's first talk about, let's first take this off, and let's first talk about the first impulsive move that we get with 2008. So, first 2008, you get a massive push to the downside, breaks our key level of support right here, and then now you get a massive low with a huge wick, and then you retest that low, and then you get a squeeze here. Horizontal level of support, descending level of resistance, and you get a squeeze, and then you get a series of higher highs and higher lows. So then, that's going to be your low, a swing high and a swing low. You don't have to, theoretically make money trying to catch this low, because it could be here, it could be here, it could be here. You don't exactly know. But if you are looking at fibs, you have the opportunity to then have zones then give you opportunities where you have key levels of supply. So our supply zone was around right here, 61.8, looking at back tested, and then 50% right here. And then we can see there's a wick that just came into this zone. You're looking for failures. You're looking for weakness from the bulls. So you draw an ascending trend line. You could draw an ascending resistance there. Could be a wedge. Could be an ascending channel. But you can clearly see easily identifiable weakness with the wick right here. And then you see a key level of support break down. And then you see a series of lower highs and lower lows. That's definitely a downtrend, and then you don't have to catch the very top. If you are going to speculate that this is going to be similar to every other recession in terms of the price action, you don't need to catch the very top to bottom. You don't need to have a super tight stop loss, because at the end of the day, in my opinion, not financial advice, this is a pretty high risk reward dependable situation that you're finding yourself in if you are able to gain exposure to the downside and you are active and aware of the risks involved with shorting any market. Going on to the next impulsive move, you get another correction here, and then you're looking for correction right here after the huge move to the downside, and then you're using that previous swing high right here and then the swing low to draw another set of fibs. And that's basically what the market structure that we're using. So then let's put this back on. In this situation, we actually didn't hit the 50% or 61.8. We did hit the 38.2 very, very well, but the main area we're looking for is in between these two key zones that we did identify. So for 2008, we did actually do one, very, very clear, easy to understand. The second one, we actually didn't hit the 50%, but what this, in my opinion, shows is if we go here and then let's just change, so we have the 382, little break, second rejection, got a big wick, and then you have a small little, actually well-respected ascending support there, reject 1, 2, and then you're getting massive sell pressure, and look how far that fell. It didn't even get to the 50%, so in my opinion, that kind of shows the level of confidence of the sellers or the level of weakness from the buyers, knowing that this is definitely not going to go back up. So let's take that off. And then let's now go to the dot-com bust, which is 2001 and then 2002. Very, very similar in terms of how we're trying to understand the structure of the market. So let's take this off right here. And let's just talk about what we are looking for. So this is that recent all-time high that we had within the stock market. You have a massive move to the upside, to the downside, my bad, creating a huge low right here. Sorry, my mouse is, I think the battery's popped off here. So that's the first impulsive move that we get from the market. And then you see a series of higher highs and higher lows. Quite a big bounce with a double bottom. Now you see a potential zone where you see a swing high and a swing low. You're looking for that 61 to 50% retracement level. When you see the price around this zone, you're looking for weakness. What do we see here? We see a move to the upside. You see another move to the upside. You see the third push, and then you see a pullback, and then you see the right shoulder come in, which in my opinion is going to be a nice head and shoulders reversal pattern. You get a break in the neckline confirming the pattern, and then you see not one, but two rejections to the downside. You see a pullback does not make it to the recent high, creating a lower high. You see the pullback attempt for a second time does not make it to that previous lower high, and then you see absolute capitulation. And that is a massive move, and for that bounce, yeah, you would have to have a trailing stop loss. You would have to be aware because at the end of the day, you want to be able to capture the meat of the move, and trailing stop losses are great for that because it just continues to go down as the price goes down, and then once the price starts to move back up, you are not actually going to see any of this loss because the market will take you out at the specific zone that you're looking for away from the price, which is extremely handy if you are in a liquid market that trades 24 hours for 5 days of the week, like futures or contracts for differences or CFDs. What time period chart do you most look at when trading? By James. Right now, I look at the daily, I look at the weekly, I look at the 4 hour mainly, and 1 hour is going to be my time frames that I execute on. For crypto, I sometimes look at smaller time frames. I'm trying to not really look at anything under an hour because increased volatility, increased emotion, especially BTCs and like a consolidation that's getting a ton of demand at around 6,700 ish is a zone where there's going to be a lot of buyers, and I think that if we do see a move to the downside breaking this support zone, we're going to get an aggressive push to the downside because there's a lot of stop losses at that area, because I think there's a significant portion of the crypto community who think that the BTC halving is this mystical date in which there's a shit ton of buyers going to come into the market. It's just the miners are going to get 50% less BTC for a reward when they mine a block every 10 minutes. That's what this is. And over time, yes, it's extremely positive for the supply demand, because if you cut out half the supply and if you at least maintain demand, if not increase the demand, the price will appreciate. Just simple economics. So long term, super bullish. In the short term, I think that there's going to be some miners who are unable to continue operations due to the inefficiencies of their mining operations, unlike some other companies who are able to basically mine for almost free. Obviously, they can't do it for absolutely free, but yeah, they definitely can get extremely cheap energy. All right, so that's going to be one question. Let's. Do you put options? No, I trade what I said, contracts for differences, or CFDs. I do not trade options like for SPY or SPX or anything. Don't really get into that, but that's just me. Oops. Let's just check here. A negative reaction. I think the United States needs to tell China the debt is paid for. My hedge is going to be crypto by Random Spook. Yeah, that's, I think, long-term a great hedge. Right now, BTC and traditional markets are actually pretty correlated. BTC's, I can't say highly, but pretty positively correlated with the Russell 2000, actually. I think it's like 0.67 positively correlated. If look into like Pearson's coefficient of correlation, I think it's called, for the understanding of like correlations, but yeah, it's pretty correlated. So I think if there is a next dump, there will be a confluence of the stock market going down as well as BTC because of the correlation, and then miners will get squeezed even more. So then there's going to be somewhat of a capitulation, but then through the ashes of that, there's going to be a reduced supply. The inefficient miners are going to be out of the market. Let me get some water here. And then if the demand continues, if not increases, I think BTC will see huge price appreciations, and then people will look to it as a potential safe haven asset, as a hedge against global uncertainty because of the price appreciation. But there are fundamental network factors that play into the confluence of that trade, not just, oh my God, it's a hedge against or it's a hedge against inflation or whatever. It is because there's a fixed supply. Yes, there's 21 million, but there's actually less because people lose BTC and stuff. So there's actually less than 21 million that are actually going to be in circulation when there is going to be a complete lack of BTC to be made at a certain point, because there is a fixed supply. Once there is all the BTC mined, there's going to be no more. So, you know, think of how many people there are in the world, think of how many millionaires there are in the world, and think of how many BTC there are in circulation, and then divide that basically, and then you kind of start to see the capabilities of BTC being in the millions of dollars for one. So looking at the YouTube here, Michael Francis, do you think we will start off sell off before April end? Let's look at the S&P. In terms of time frames, I personally don't really like to give time frames because I like to trade the chart. It could consolidate here for a while. I don't mind because, yes, I am paying fees for shorting, but at the end of the day, I don't really mind because I would like to have exposure when this does fall and capitulate, in my view. That's why I'm betting against the market, but yeah, that's basically what I can tell you. It's going to squeeze closer and closer towards the apex with a series of lower highs, I do believe, and then we're going to see some news factor, something that's just going to take it off a cliff, and then they're going to say this is the reason, but in my view, it is the confluence of the price action before the actual news. And if I'm wrong, hey, I'm completely wrong. I'm wrong a lot in the market. I can't say that I'm perfect. No trader is, and you know, we stick our necks out and basically give our view of the market because we have conviction in what we say. All right, let's go to the next question. What do you short the S&P with, and what do you use to ride the move up? From Jay Francis. So for shorting, like I said before, CFDs, contracts for difference. They're somewhat similar to futures in that you're trading a contract. You're not trading the underlying asset like you're trading on Binance. You're like actually purchasing Bitcoin or Ethereum or Ripple or whatever coin you're trading. But with contracts for differences, you're trading a contract kind of like the derivative markets of crypto like Bybit and BitMEX. A lot more flexible, which is great. But unlike futures, you don't need delivery. I'm never going to get delivered my, equity for the S&P. I just will never get it, and it's a trading instrument. It's not for extremely long-term holds. And then on the way up for investing, I just use Wealthsimple. I'm a Canadian, and then that's like free long-term investing. It's free to invest for that, but right now I'm not really thinking of investing in any equities, to be completely honest. I'm pretty well into heavy crypto commodities, and I have a lot of cash aside for trading because I'm an active trader. Not active in terms of like every minute of the day I'm a day trader, but I do like to have my portfolio set aside, which I can navigate the markets when I do find high probability large setups that I view have potential. What specific indicators and or price are you looking out for S&P sell-off? From Tommy McGee. Okay, I'm gonna get some water and then I'll answer that here. All right, so let's get our snip. So my initial zone was when we broke this ascending zone. I have entered the market short, and what we currently see right now is a break from a move to the upside where we're seeing a series of higher highs and higher lows to then we're now seeing a consolidation. So before we were in the pullback phase, in my view of the market structure. Now I view it in a consolidation phase. So that's great. I'm just looking for that validation from maybe one or two more lower highs, or at least a consolidation here. And that's basically the confirmation that I'm now in this phase of the market, this consolidation phase of the market. And what we're looking for to add to our position is now a breakdown from this consolidation phase to the breakdown phase. And we can actually provide an example of that in so many different situations. We can see Dow Jones, looking back, we kind of went all the way back. Let's just go back to this example that we had here. Let's take a picture. In talking about that same market structure, we saw a move to the upside. We saw a consolidation where we saw a series of higher highs and higher lows get rejected, series of high, lower high, lower high, lower high. So we're seeing lower highs now shifting the trend from a series of higher highs to a squeeze downwards, but we're holding a support. So we're getting squeezed into an apex, which is right here. The price has to make a decision. Yes, we could move to the upside if it does break the resistance. We have to be nimble. We have to be flexible. But if we are seeing a breakdown of this zone, you're seeing two things. A, the psychological zone that you are breaking after all of these people are now under, meaning that they are now negative in their investment, in their trade, whatever it is. Anyone who bought February 8th and after are now in the red who are long. So that's a huge zone to break. For one, that is indicating that there's going to be a lot of stop losses there. Once they get triggered, we see that there's a huge reaction to the downside. You do see some consolidation there, and then you get a massive sell-off yet again. And then what you're looking for within this stage is now you have what you have. The momentum is kicking you off. This is the momentum that you're looking for your continuation patterns. These are going to be your wedges, These are going to be your channels or your flags. These are going to be for your ascending zones, your potential descending zones if they do come. This one, you could argue, is a potential head and shoulders on the break. You do see a break up of the, let's just make that a little bit cleaner. You see initially a horizontal zone, and then you draw a little squeeze that occurred. So then now you're looking at a market within a consolidation like so. So then now you're looking at a consolidation. You see a break in the resistance. This, in my opinion, is a fake out for the bulls that are looking for potential opportunities for longs, and then obviously the whales were intending to sell. So then looking for liquidity, they bump up the price above the previous resistance. And then you see a series of higher lows, you see a little squeeze, and you get your massive dump to the downside. And once you see it break the resistance yet again and go back into the sideways consolidation zone, you're definitely looking for sell pressure because it tried to break above the resistance zone. And because your bias is bearish, using the fundamental factors to play into it, you can then look for sells once the price is putting back into the consolidation. And once it breaks the support there, you know that you really, really want to be selling short. So in terms of when to exactly do it, I can't give you an exact date, but I am notifying the Performante Premium members of my entries basically, and it's looking pretty favorable right now for a potential another one. We'll see how much hesitation we get. We do look at the 1 hour as well, but we don't really look at the 1 minute or 5 minute when we are trading. All right. So basically we look at TA, little bit of volume, looking at mainly no demand candles using VSA volume spread analysis, and then TA using market structure, price action, and VSAs are three pillars of how we approach the market. Also using top-down approach, we heavily rely on looking at previous market structures to base our thesis off of, backtesting them over many recessions, looking at not just one but basically almost every recession that we can within TradingView for the equities market, really. So it's back tested. I do believe that it is a high probability situation that we will get not just another dump to the low, but surpassing the low by a significant amount. We do have extensions here at the 272 and the 618. And the 1550 zone is a very important level, and we can actually look at the reasons why right now. Let's go back to the SPX daily and zoom out on 2000.com bust and 2008. We see that both highs were basically right at the 1550-ish mark. So that is a key level where potential demand is going to be located. I assume that there's going to be some huge bounce or some bounce there because that's such an important zone within the chart. But in that said, that doesn't mean that we're going to have the low there. We'll obviously have to see the market structure and how fast it gets there. And it's so far away from now, so we'll see how it goes. All right, what is the live about? I just joined. Well, it's been a while, but if you just joined, we're just going over S&P macro, financial markets, crypto, swing trades, not 10-year investments, but 6 months, 4 month swing trades, basically, of major indexes, basically. So that's basically that is what we're doing. All right, I think if somehow the economy can be reopened, it could be a heck of a turnaround. Yeah, I agree in that if they could, but in terms of opening up the economy, you are seeing resurgence of COVID in Singapore, in China, where they're very, let's say, heavy-handed with how they handle their restrictions and how authoritative they are, I guess, of the policies that they implement, and they're seeing second waves and third waves. So obviously I do wish the best upon humanity, but in terms of the opportunity that this presents, if they open early, I do think that it will cause longer term damage instead of just saying this sucks, but we're going to have to basically hunker down for 2 weeks. But there are people who are opposing this and saying this will kill a certain amount of people if we just Sweden. I believe Sweden is completely open in terms of their economy, like restaurants, bars, and we'll see. Yeah, Sweden. Yeah, that's crazy. So we'll see how it goes for them. Futures or CFDs? Yeah, I'm trading CFDs. Whereas, like futures, you have to get delivery. So people got wrecked, trying to buy oil at like a penny, thinking that it was a risk-free trade. And then they have to get delivery of this oil. So what do you do with, if you bought, let's say even 100 barrels of oil, that's to someone a lot of oil if you live in an apartment. You can't just store that somewhere normally. So be careful of what you trade if you don't know what instrument you are using. With the history of recessions, do you see the S&P hitting a lower low? The pilot Daniel, I definitely do. Let's look at, just for example, 2008 and 2001. Let's look at 2001 first. You see bounces of either 50% to 61.8%, and that's going to be the supply zone, meaning that's where sellers are going to be located by using this strategy of the Fibonacci and using price action patterns in the areas where you see supply, which is in red right here. So yeah, in my view, this has happened time and time again. This level of a bounce is completely normal in the market structure of a bear market. Could not be more normal. If it breaks 61.8, then it's worry of, okay, the economy is obviously going significantly to the downside, but the Fed is printing so much money that they are devaluing the dollar quicker than the value of the stocks going down. And we've seen this in Venezuela. We've seen this in Zimbabwe. When Zimbabwe and Venezuela were having their hyperinflation, the stocks were skyrocketing. They were having 200-300% gain years. But the fundamentals, the sales, the revenues, the operations, they're going down in those countries because of the economy being so bad. But the comparison of the whatever share you're looking at versus the native currency is going down faster than the price of that share. So then you're getting price appreciation if you're comparing it to that native currency. Whereas it's kind of scary because the native currency for the entire globe is the United States dollar. The United States is the world reserve currency right now, right? So at the end of the day, if this turns into Venezuela but the globe, you're going to have price appreciation in basically all assets because USD is going to devalue so aggressively to the downside. So it's going to be a crazy world. You're going to see price appreciations in all assets across the board, but it's not like the value of a lot of them are going up. Like a value of an apple, it's not like it's going from this normal food to this extremely robust, nutritious meal that's going to fill every part of your nutritional need. Like the apple doesn't change at all. It's just the comparison versus a unit of currency versus that apple is getting disproportionately greater for the apple. So it's a different way of looking at appreciation and depreciation. It's not the value of the share, it's the value of the currency that you're comparing it to. So I think a lot of people will look at the market in a different way when we have that comparison. And there may be a detach sometime in our lifetime where we're never going to compare things to the US dollar because we'll be talking in the millions for basically all shares, and hundreds of thousands of dollars for a Cliff Bar, like think of it's possibly impossible. It's impossible, but it's happened in the past. You know, Rome back in the day, they probably thought that they were unstoppable, and you know, how could this entire empire ever be tackled down? Do you know what killed them? It was their poor monetary base and the devaluation of their currency, and that's what took them down. And if you know, economies, in my opinion, have sound money principles built into the monetary system in which individuals and humans can't really change it, where it's built into the monetary base. I think that over the long run, with productivity growth, we will be able to see a sustainable, less volatile future where we're going to have massive, you know, busts and booms. It's a part of the cycle, but this is very destructive. And inflation itself, in my opinion, is not a positive thing. I know that a lot of people think that inflation is the best thing in the world. Keynesian economists praise inflation for saving the economy, but what's wrong with rewarding savers? Nothing. Technology itself is deflationary as a default due to the fact that technology itself is trying to make things more efficient. How much does it cost to Google something on your phone? Absolutely free. You just need internet. You can go to Starbucks. You can get a cheap phone. The amount of efficiency and cheapness we have now with the amount of knowledge we're able to attain is unbelievable. And that itself is deflationary because you're taking away jobs basically by creating new technology. So I think we should embrace the fact that things are deflationary. We should reward savers instead of rewarding debtors. And that's just my personal belief. But, you know, rewarding going into tremendous amount of debt and over leveraging yourself 10, 100-fold, and, you know, basically that being the norm, in my opinion, isn't really a healthy economy. And you see that in governments, massive corporations, and everyday individuals, in, you know, not just the United States, but in Canada, Australia. There's a lot of countries that have a lot of indebted individuals. All right, so where would you recommend complete beginners to start from? Okay, I think I skipped a few stuff here. Let me just check. Give me one moment. I do want to answer all the questions. Do you think of a war would help with the... No, I don't think a war would help with... Well, in America's case, it would help with the economy in terms of them being able to build a bunch of stuff and basically shift their entire economy to war, which is obviously not... In my opinion, it's not the answer, right? Like, there's other opportunities instead of just, okay, let's just kill a bunch of young people and... like, I don't know. Now, with the amount of technology... you could end humanity very easily with the amount of nuclear weapons that the world has. Like, America could end all of humanity like 10 times over with the amount of nuclear power they have. And that's just scary. You know, like, the idea of if I'm going down, you're going down with me is not something to be looked upon as a positive outlook at all, in my view. So I don't think that's the answer, and I really hope that isn't the answer. Although, if you do look at the 1920s and the Great Weimar Republic in Germany, that is how Hitler came to power. Is there was desperation in Germany due to the hyperinflation of the mark, which was their native currency. You know, I don't exactly know the percentage, but it was like Venezuela, it was like Zimbabwe. They had massive hyperinflation, and, you know, people's entire life savings got absolutely robbed from them, where, you know, if you saved up your entire life for, let's say, $100,000, and then that $100,000 could get you 1/10 or even 1/100th of what you could have gotten, let's say, 5 years ago, you're wrecked. Like, your entire life savings just literally washed down the drain, and you're gonna revolt. You're gonna have these leaders that are going to use that desperation, that depression, that anger, that hatred towards the system, towards the world, whatever it is, to point it at someone, something, and say, you're the reason for this pain, and that causes wars. And we're kind of seeing that right now, which is super scary because like, some people think that war is needed, And to some degree it is. I do agree. But it's not the answer to most problems. I don't really have too much to say on the actual opinion of like the more intricate, granular details of war. To be completely honest, I don't know enough about it. Never been in like the military or anything. I'm Canadian, so yeah, I have not a lot of experience in that form. All right, so let's go on to the next question here. Not a huge fan of guns. All right. Wow, nice overview. Thank you very much. Where would you recommend complete beginners to start from? Interesting to know. Where would you recommend complete beginners to start from? It depends on what you're looking to learn, right? If you are looking just for global macro overall understandings of what money is, there's so many different facets to. I don't like there's crypto, which is an entirely different separation from the more global macro long-term monetary shift that we're seeing right now, where Bitcoin does play a part in it, because I think blockchain will play a vital role in the progression of our monetary system, the efficiencies of global payment, the privacy, the ability to have peer-to-peer networks that don't involve a third party. There are huge benefits to cryptocurrency, being able to bank the unbanked, have very cheap fees. If you're a person cleaning a house and you live, and your whole family lives in like Singapore or Vietnam or like some South Asian country or something, you're paying like 8% of all you send in fees. Which is a lot of money. And if you send it with a very fast, almost frictionless payment system that some blockchains offer, well, then you really have an opportunity to cut out the middleman and save a lot of people money, which is just economically, it just makes sense. So it just, in my opinion, makes sense to look at this as a huge disruption in what we currently have as just as a sliver of blockchain, a global payment system. All right, so I gotta run, but thanks for the content. I'd love to join the next live. Do you use any indicators for entry? No. So we already went over this. I use the three pillars I use is market structure, I use price action, and I use volume spread analysis, or VSA. And we go through a top-down approach using weekly, daily, 4-hour charts. We do use Fibonacci's, but not overcomplicated. We don't use like MACDs, RSIs, ADXs, Bollinger Bands, MAs, EMAs. We don't really use any of that. I will look at a 200 because that's a pretty important trend line to look at, and I will throw it on a chart every once in a while. But at the end of the day, the market structure will change before the moving average, and I've grown accustomed to not putting it on my chart, so that's totally fine. Everyone trades differently, but I trade in a pretty clean format, in my view. All right, what do you think of the Bitcoin chart? Basically, in terms of the fundamentals, I'm just going to get a drink of water here. All right, so in terms of the fundamentals, before even talking about Bitcoin's chart, some things to understand. Bitcoin has a high positive correlation with traditional markets like the S&P and the Russell 2000. It has a higher correlation with higher risk on assets like the Russell 2000, which represents the small caps, compared to the S&P, which represents the 500 largest companies in the United States. And you can Google it after, but the correlations are, I believe, 0.69 of positive correlation with the Russell 2000 and around 0.50 or 5.1, 5.2, around there for the S&P and positive correlation with Bitcoin. So they're positively correlated recently within 2020 Q1. They're way less correlated. They're actually not even correlated at all if you're looking at from a 10-year, 9-year standpoint. But right now, Bitcoin is perceived as a risk-on asset correlated with traditional markets. So I think we'll see a decoupling, and Bitcoin will start to see the correlation diminish, but let's quickly look at a link I have right here. Give me one moment. Let's look at it here. Give me one moment. Same macro. Okay, it's right here. Okay, I'm just going to bring this over. So this is the correlation between Bitcoin and the S&P. This is where I'm getting my information. So let's look at the 1 month. This is going to be the most recent statistic on the 21st. So it's a day behind, but it's pretty well live. The correlation right now between the S&P and Bitcoin is positive 0.31. And we can see it's been increasing if we go back to 3 months instead of 1 month. This is January 26th. We can see that it was negatively correlated, a little bit neutral. So basically no real correlation before the drop started. Once the drop started at the beginning of March, we saw a huge spike in correlation of the S&P and BTC, and we've been seeing it continue upwards. So I do think we will have, in my opinion, another dump from the stock market, which means that because there's a high correlation, we do have to look at BTC in a little bit more bearish of a sentiment. And that's just one sliver of the fundamentals. Let's now go into a whole other set of fundamentals, which is now going over the current setup for the minor capitulation. Actually, I'll take this off the chart and then go like this. Okay, so I have two indicators right now on this daily chart for Bitcoin. All right. And this is also talking about the BTC halving. So this is going to talk about minor capitulation, BTC halving. So we have two indicators on this current chart. The first one is going to be this, I guess you could call wavy moving average indicator. And this represents the Bitcoin difficulty, which is basically the hash rate. So we have moving averages of the hash rate from, we can see the 9-day to the 90-day. And I have the 90-day in red and the 9-day in green. So we saw a initial difficulty adjustment right here because we see that the hash rate dropped, which means the amount of miners mining to get that same reward has lowered. The more miners there are mining for that same single pool of BTC reward, the hash rate will increase. It's a difficulty. So then at a certain point, there's going to be more and more miners coming in because initially it's very lucrative. Like if you look right here, the hash rate is not too difficult because we recently had an adjustment, and if we overlay another chart, we can see it a little bit more clear. But initially at the start, the hash rate is low and it's pretty easy to mine BTC. It doesn't cost too much energy, so you make a good profit. And if the price is going up, you're just keeping some BTC in the treasuries and it's looking great. As time goes on, obviously with money, there's competitors in the market. And there's always going to be that in free markets, which is great. And then as it's profitable, there's more people coming onto the network mining for the same pool of Bitcoin because every 10 minutes, there's an amount of BTC that gets distributed to miners. And that doesn't change. It only changes every 4 years. And when we're seeing that adjustment very shortly here in less than a month. So as miners come onto the network, it gets more and more difficult. So then the energy costs get higher and higher and higher and higher, which means that if Bitcoin consolidates or starts going down, you're getting squeezed because the revenue, you're selling Bitcoin. That is your revenue. Your costs is electricity mainly. You're also paying for employees. You're paying for real estate or rent. You're paying for lawyers, administrative fees, all this stuff, right? A business costs money. And as the business sees BTC go down, it's directly associated with the revenues they are taking in. So as difficulty gets higher and revenues decrease, you're going to get a squeeze. And this is minor capitulation. All right. And that's one part of it. Now let's look at this next indicator, which is going to be the Bitcoin production cost. And we see the top line, we see this red band. I'm sure you can see it on the screen. The top area of the band is going to be the total cost on average around the globe to mine one Bitcoin, with everything included on average. Employees, rent, electricity, everything. And we can see right now it's around $7,900 USD to mine one Bitcoin. And the bottom area of the band is going to represent just the electricity cost to mine one Bitcoin. And we can see that the electricity cost to mine one Bitcoin is around $47.63-ish in USD. $4,763-ish dollars. So we can see what this is showing us, and this is on average around the globe. It's not going to be for just a single miner. Some people are way more efficient at running their business. They reinvest into the business to get better equipment. They make deals with energy corporations or governments, or they make it happen in order to get the cheapest energy, because that is what's going to drive profitability for the BTC network and mining as a company. So what we're seeing right now is, on average around the globe, we're seeing that miners are actually not able to make a profit right now. On average, there's some people who are able to make good profits still. I can't say there's every single person, but on average around the globe, it costs more to mine one Bitcoin than it is to sell it. So they're under pressure. They might be continuing operation, consuming electricity at a loss. Same as oil. BTC is supposed to be looked at as a commodity one day. And it's actually very similar to what we're seeing in oil right now. The cost of oil to produce is more than to actually sell it. And obviously oil's in like a complete capitulation, but similar supply and demand situation. But in my opinion, BTC is better well suited for this, because what is going to flourish from this is going to be not just the miner capitulation, where you're going to get a lot of miners that cannot operate anymore, that are going to go out of business, that are not going to get bailouts, because obviously cryptocurrencies are not quote an essential service, although I think that bailouts should occur for public companies, because someone will buy up the airplanes, the employees, everything, and that's what free markets should be. But these companies will not get bailed out, and then that same pool of BTC reward that gets distributed every 10 minutes is going to flow into the most efficient miners. So this is a system to flow and funnel capital, BTC, to the most efficient miners in the network. And it's a cyclical system designed to provide capital, to flow capital to the most efficient miners. Because as the hash rate increases, there's going to be more people coming in that are going to basically clog the hash rate in order to make it more difficult to mine Bitcoin, coming from an electrical cost standpoint. So this is a mechanism to basically flush out, reset the mining network, so only the most efficient miners are withstanding this bear market for miner capitulation. And then once basically all the bankrupt, all the inefficient miners leave the market, what's left? You have a supply that is cut in half from the BTC halving, and you also are getting all the BTC, that's the majority of the supply in the market. It's not short sellers that's the majority of the supply in the market. It's miners that are the majority of the supply of the market that's pushing the price down. So if all the inefficient miners are gone and the only miners that are left is the most profitable, most efficient miners, they're not going to be selling when the price is going up, because they were able to withstand all this whole move to the downside. They're going to be able to withstand this whole move to the downside, the most efficient miners. And once the rest of the current miners capitulate that are inefficient, it's going to flourish, in my opinion, into an unbelievable bull run, because this is a speculation, but there will be a decoupling from traditional markets, between BTC and traditional markets. And the fundamentals of, the infinite QE, monetary expansion to, hundreds of trillions basically, because they're just throwing $2 trillion around like it's no big deal. And when it does drop again, they will be injecting more. They will be injecting a shit ton more into oil, because until there is economic demand for oil, there is a glut of supply, right? It's not like you can just click a button and all the supply instantly stops. There's a supply chain. It's not like it's that easy. So there is still supply coming into the market with zero demand, because airplanes, cruise lines, cars, trucks, no one's doing like there's essential services, but basically the entire globe is on lockdown, right? So the oil that's needed for everyday use is no longer needed. So there's no demand, there's still supply coming in, and, just injecting money won't make the oil disappear unless the US government literally wants to buy the oil and put it somewhere. But there's just no place to put it. So it's crazy. All right. Jag, which vehicle do you use to play dollar strength? So yeah, same thing. CMC markets, I use contracts for differences, CFDs. You can trade Forex on there. You can trade indices, S&P, Russell 2000. You can trade a lot of different, you can trade contracts that provide you exposure to many different types of pairs, assets, and all that stuff. So I recommend it. It's great. And I use Binance for my cryptocurrency trading. All right. Hey man, love the content. Well, thank you very much, Rye. Do you explain economics? Do you explain economics on YouTube elsewhere? Marcus Westerland. We have a YouTube channel. Definitely subscribe to our YouTube channel if you'd like. We post weekday videos, so every weekday we'll post videos. We look back at we do stuff that I think a lot of people don't do in terms of going back to previous time frames. We'll look at the 1930s. We'll look at 1970s in terms of price action. I just absolutely love charts. So looking back at what the economics were in line with the price action really gives me a clear understanding of how time has been, because obviously you can't go back for generations and generations. There's a finite amount of time, but the price action's there. The stuff I read is there and set in stone. It had happened, so it is very interesting to me. All right. So yeah, definitely the YouTube channel is the best place for sure. Thanks, man. By the way, podcast was good, but the volume was kind of off. Yeah, definitely. We're going to get that fixed, James. Thank you very much for bringing that up. But the pandemic is going to affect BTC halving. I don't know. I don't think so. In my personal belief, it's not like there's a real worry for that in my view. I can't really think of anything. In my personal opinion, I think there will be first a surge again of the dollar, and then everyone will be hoorah, the US dollar is the best thing, and the central government, and it'll almost be too much, and I think the central banks will overreact, to be put simply. In 2008, they said that they didn't do enough. They said we didn't do nearly enough QE. There's way more liquidity that we should inject in the system. And it might not take a week, a month, or even a quarter. But the actions taken with unlimited QE will basically, in my opinion, break down the dollar to a point where once the velocity starts to pick up for the loss of confidence, and once there is that threshold of is this really worth this much as a global psychological point, that is when you will there's a point of no going back in terms of velocity of currency, because once people don't really want to hold it, they're wanting to purchase something else instead of holding that dollar or that whatever currency that is being inflated. So at that point, you can't do anything about it. And then people are screwed, because the only way to do more is it's a never-ending cycle. Because in order to pay off debt, the only thing you can do is print more money, which incurs interest, which you can't pay off, because the only way to pay off debt is to incur in more debt. it's a never-ending cycle of more debt. So the entire system is unable to get out of it unless there's just some systemic closure and reopening and reset of a new monetary system. That's basically the only outcome that would happen if we don't get hyperinflation, because as you might want to, if you need to, you might want to know what this is. Keynesian economists basically are, their statement is, in times of recessions and depression, we will run unlimited budget deficits. We will print unlimited amounts of money and just put it on the balance sheets because it's deflationary, it's fine, we'll pay it off at a later point. And this is modern monetary theory in play right here, basically. Unlimited budget deficits because we are able to basically buy our own debt. Japan's been doing it for years. They haven't had any inflation because they've been in a deflationary spiral for such a long time. And that's basically what people are pointing to and saying, hey, they did it, we can too. But yeah, we'll see how it goes. Japan had a massively skewed demographic in terms of the amount of old people versus new people, so it was a very, very deflationary time. So that would severely combat the inflation caused by basically the money printing, in my view. All right. Next question is, would you buy USO right now, and how long do you think before it goes back up to around $12? I have no idea. I do not recommend anything involving oil. I don't know enough about the oil market, and that's just for the first. For the second, there's so much. There's so much happening right now in the oil market. I have no idea. I could not tell you the first thing about when would be the ideal time to invest in oil. Not my forte. Thanks for the comment, man. We'll subscribe on YouTube. Appreciate it, Marcus. Is this the USD? No, this is Bitcoin, but we can look at the US dollar. And this is DXY, which is going to represent a pair that is somewhat representation of how strong the US dollar is. It's going to be paired with 60% euro, 15% yen. There's going to be some level of GBP, I don't remember, some level of the krona, some level of the franc. But I don't know the small percentages. I just know the 60% and the 15 from euro and the Japanese yen. So anyways, what I actually see is a potential strong push to the upside here, and here's why. Let's go here. And we have a descending zone connecting by the lower highs, pretty well respected. Squeezing the price lower, and then we see a low right here. We see a higher low, we see a higher low. We did get a squeeze, and it actually broke the resistance, which I was a little bit surprised about. I thought we were going to get another little spill, maybe with a descending zone like here, but we actually broke to the upside, which showed me quite a bit of aggression and conviction from the bulls, and then we got a strong push to the upside. We held the previous resistance, as we can see right here. Let's just take the rest of this out. We did get a resistance that held right here, and we see that same thing, and then we are now testing it for a new level of support, not just once, but multiple times, creating a nice little channel here. So like we said before, within any market structure, we're not looking for a massive, just straight move to the upside. We need the market structure to shift from a downtrend to a consolidation to an uptrend. So right now, we see that the market did actually break out of that consolidation, and it looks like we are seeing a move to the upside, which in my opinion could be a bit of a front runner for a potential sell-off for the S&P. So we'll see how it goes. Let's just get that right there. Basically $100 is the key zone that we're seeing, and if it does actually break that zone, I think we could retest the 103 range, if not actually go higher. So we'll see how it goes for DXY, but that is my analysis on it. I'm not really going to be trading it. I'd rather trade the S&P. Gold, I'd rather trade crypto instead of this in particular. Here, a little late. Are you still short the SPY? Yes, I am still short the SPY. Have you heard of BTC renting? Renting Bitcoin. I think you mean in terms of like loaning it out and then incurring interest. I definitely know of that. There are companies that provide that for retail investors, which is great if you are trusting of that third party to hold their end of the deal, basically. I'm not going to name any because I don't want to promote any single company, but there are companies that provide interest on different cryptocurrencies that you loan out to them for a period of time, and you lock in a time frame, let's say a year, 3 months, whatever the time frame is. You'll be able to lock it in, and then you will be able to incur interest on that asset. So if you hold Bitcoin in your Nano Ledger and you feel like you want to incur a little bit of interest on it, you could give some of your Bitcoin to a well-vetted exchange or company that will allow you to loan that out and incur interest. So yeah, I do know of it. It's a good opportunity if you do trust third parties, but if you think that you want your money to be your money, might not be the best situation. It depends. All right, so that is basically the completion of the video. Don't really have any more questions here. Thanks. Yeah, no problem. Yeah, I don't really have much else to say. BTC still doing its thing. Holding below that zone. Actually, let's look at Bitcoin because obviously it's an important asset that we like to look at. We've identified where that BTC halving is. And this is currently how I'm viewing the markets right now. I don't really want to be putting any entries until we actually break this consolidation. And I know it's not super, actually let's just go to the 2 hour. All right. So I don't really want to be entering any trades until we break this down. Like I said, we're not looking for day trades, to be completely honest right now in this market. We are looking for major moves that are able to provide us good risk reward. So we got our first touch right here. We got a whole zone of resistance, a lot of rejection. We see another zone right here, reject yet again. So we got 1, we got 2, and then we got 3 areas of rejection. And now we're seeing our fourth confluence of this support zone, which I guess you could argue is a head and shoulders. And now we're getting our retest of the head and shoulders. And I am expecting this to continue to the side, basically until we get some sort of catalyst that's going to push us down, because we have a lot of time until the actual, oh, I didn't put it in here. Let's look at May 12th, around there, 11th, 12th, right around there. So that's going to be the BTC halving around May 12th. It's not an exact time, it's a number of blocks that it mines, so it's similar, but it's not going to be an exact time frame. It's going to be like within the technology that it actually is going to calculate when to do it. But yeah, that's basically my plan. Is we can see that it looks very similar, except BTC is actually in a consolidation, whereas the S&P is still sort of kind of at the low, whereas BTC is a little bit higher. But let's just move this here. That's basically what I'm seeing the market as right there. Yes, that could be an opportunity for a short, but I could see it still move up here and then break this trend line. And then now we're in a consolidation sideways. I personally am not willing to do it. I've shorted right, where did I short? Initially I shorted right here, I know that, and I got this big move to the downside, basically right here. And then another one was along right here. and then I got stopped out basically right here. I was looking for 77. I don't exactly remember, but basically, I've been stopped out on shorts, on alts, enough times, basically 3 times to warrant, and BNB, for me to warrant that this is a wedge that turned into a consolidation sideways. I'm not really looking to enter until we start to see the momentum to the downside. And then I'm looking for some price action pattern that is going to give me an edge around here. And then I think by that time, you're going to have the price near maybe the halving. It might be a long drawn out move to the side here. We don't exactly know, but yeah, I'm definitely not long biased on Bitcoin just due to the fact that it's so positively correlated with the markets in terms of the traditional markets. So yeah, we'll see where it goes, but that's my personal view of BTC. We're just currently staying on the sidelines right now because we have the main bias within the S&P currently in place. So that's our I guess focus of the day, because, or of the, I guess, week or the current situation, because of the fact that this is going to move BTC for sure. So, you know, this is going to move BTC rather than BTC moves this, in my personal view. All right, so I don't really have any more questions here to go over. I think I'll close it off. But yeah, I'm definitely I'm short, and I'm short bias. It will baffle me if it actually breaks the 61.8. It will absolutely baffle me. But I do have to be flexible enough, be aware that I have to manage my risk, that if it goes above this zone and holds above this zone, I will probably have to get out of the market. And if the market does shift to the downside, I will change my bias. The fundamentals are way too bearish for this to just be this move. Compare the statistics of the number of job losses in such a quick amount of time and the amount of impact that lockdown has hit in not just the jobs, but think of global supply chains. People have cut entire crops of corn, of everything, of coffee. They have to kill like tons of pigs and chickens and just drain shit tons of dairy because there's no demand for. The restaurants are not open, so there's way less of a demand for it. So then there's going to be a point in time where that impacts the entire supply chain, and that's just thinking of a couple industries, right? This is absolutely huge, and theoretically, the US dollar could devaluate quicker than the value of shares. We've seen it in past monetary collapses, but you know, at the end of the day, I just don't think that they might allow it. But then, you know, with our position in BTC, obviously we're looking at the market in both ways. If the market does move down and the Fed fails, we have exposure in this potential bear market, and that would be a fantastic trade. Obviously terrible for the economy. Regardless of the situation, it's really bad for the economy, because if the stock market does go up, well, that just means that they're devaluing and debasing the US dollar so fast that it's devaluing faster than the stocks and share price of the index 500 largest companies in the United States. So either way, obviously, it's not good for the economy, but the better option for the economy would actually be to let it fail and then create a new monetary system. Then you're not going to have to go through hyperinflation, which basically destroys all wealth for people who are savers, which is obviously really, really bad. But, you know, that might be the path that the central banks at the Fed are thinking of doing, because they have no other option. So, yeah, we'll see. I'm going to get off. I don't really see any more questions. Thank you very much for watching. Till next time, have a good one.